Hello traders, Mark P. Markets here. My name is Mark Principato and I'm a chartered market technician, and thank you for watching another exclusive video analysis here for FX Empire. So in this session, I want to talk about the euro against the dollar Forex pair, why we exited a recent swing trade long early, and why it is now setting up to be a candidate for a swing trade on the short side. So with that being said, this is for educational purposes only. For investment advice, please consult a licensed investment advisor. Now, let's begin with that swing trade long. We had a long signal that went off, was back here somewhere. It was sometime in June there, around that 1270 level, okay? And since that trade, we had to sit through a lot of noise, okay? In fact, there was one point here where we had this large bearish pin bar, and we even had some people that took the trade as well questioning, should we get out? And our answer at that time was no. We had our stop in place, and there was nothing compelling about this setup here, or potential setup, for us to make an adjustment, okay? Why? Well, the location, the greater probability here was that this was noise, okay? But the point is, what gave us that confidence to sit through something like this was the rules that we follow. Like again, we had our stop and we let the market do its work. If it goes to the stop, that's that. If it doesn't go to the stop, we capture a profit, right? And that's the whole idea behind short-term momentum trading. So this thing eventually started to break out. Our first target was around that 1350 area, okay? As you can see, and it started to fool around there as well. When this thing started pushing, what, 1350 was as high, almost as high, like around here. And eventually it got to that target. And again, after that, bearish candle. But there was nothing to do here but let this thing do its job. Now keep in mind, we only had 2/3 of the position on at that point. So 1/3 of the risk was reduced. And that allows us to be an even stronger hand. It's like, hey, even if this thing goes back to even, we will still be ahead if we close the position at that point. Okay, but then we get one more push, and this thing pushed a high of 1452, and it took out our second target, which was around that 1450 area. Now, since it did that, though, you can see today it closed with a bearish pin bar. Now, this is where we took a look at this and said, okay, this is what we have to make an adjustment on. Why? What's the difference between this pin bar and this red one back here that we did not adjust for? Well, the key difference is this pin bar is in a much different location, isn't it? Relative to this high back here, all right, which was made at 1422 back in early June, this thing has proven to fail, which means it tried to break out, it lured a lot of longs, and now those longs are likely caught. And once they start getting pushed out, or if this thing starts to push lower and takes out this low, longs will get pushed out, stopped out, margined out, while shorts will start jumping in, right? And that creates a lot of potential for the short. Again, it's the location. This is a resistance and what we like to call a failed high, because it tests this high and there's no follow through here. It should not produce a pin bar. So how is this thing a candidate for the short side? Well, the location, the pin bar, and of course it needs to take out that low. So you can't just jump in and short this thing, right? The low is 1390. So basically you give it a little room, 1380, something like that. And you have to keep in mind it's a counter trend trade because the broader structure here is still bullish. Okay, so you have to adjust, or we would adjust for that elevated risk in case the broader trend reasserts itself, right? So how do you do that? Smaller position size and more conservative targets. So that's pretty much what I wanted to leave you with. Keep in mind, you don't have to be an economist to maneuver in the Forex markets. All markets basically move for the same reasons, and they are driven by the irrational forces of greed and fear. Those forces produce patterns in the price. And when you learn how to read those patterns, then you can anticipate what the market is likely to do. And if it doesn't do that, you have a stop in place to protect you. All right, so I'm going to leave you with that. If you have any questions, please feel free to reach out to me. You can find my information here on the site. Thank you again for watching. My name is Mark Principato, Mark P. Markets, and I'll talk to you next time. Thank you.